Hook the numbers that don't add up. Every central bank in the world publishes a balance sheet. Assets, liabilities, reserves, notes in circulation. It looks precise, mathematical, controlled. But here's the mystery. If central banks are constrained by balance sheets, why does global debt keep growing without limit? Why does every crisis end with more money, more intervention, and less accountability? Because the most important balance sheet in the world is never published. Tonight, we're uncovering the invisible balance sheet, the hidden layer of promises, expectations, and guarantees that actually runs the global financial system. Setting the stage, when money had limits for most of history, money had a hard boundary. Gold, silver, or physical currency. When it was gone, spending stopped. Governments couldn't simply create money. Borrowing was painful. Defaults were public. That changed in the late 1600s with the creation of early central banks like the Bank of England. Their original purpose wasn't economic stability. It was war financing. The innovation was subtle but powerful. Government debt could be turned into a circulating asset. Once debt became money-like, limits softened. This was the first crack in the old system and the beginning of an accounting illusion. Origin's debt moves off the books as central banks spread through Europe and eventually the world. They took on a new role, lender of last resort. In theory, this prevented panics. In practice, it encouraged risk. Banks learned they might be rescued. Governments learned deficits were easier with central bank support. After World War II, the Bretton Woods system attempted to impose discipline by tying currencies to the US dollar and the dollar to gold. But discipline relied on trust. The US printed more dollars than it had gold. Foreign central banks accumulated claims they never fully enforced. This imbalance didn't appear on any balance sheet. It lived in expectations. When the gold window closed in 1971, money officially detached from scarcity. The invisible balance sheet took over. The rise. Balance sheets become theater with fiat money. Central banks gain flexibility. They could expand balance sheets, manage interest rates, and smooth crises. But behind the published numbers, a new layer formed. Implicit bailouts, government backstops, assumed rescues. These never appeared in financial statements. Through the 1980s and 1990s, debt exploded globally, but inflation stayed low. That created confidence. Complex financial instruments spread risk so widely that no one could see it clearly. The system looked stable. It wasn't. The breaking point minus 2008, the 2008 financial crisis, exposed the invisible balance sheet all at once. Banks didn't know who was solvent. Markets froze. Trusts collapsed. Central banks responded by doing what had once been unthinkable. They bought toxic assets, backstopped entire markets, expanded balance sheets by trillions. This wasn't just money printing. It was risk absorption. Losses didn't disappear. They were postponed. Central banks could do this because they aren't constrained like private institutions. Their real limit is belief. Fallout emergency is permanent policy. After 2008, nothing went back to normal. Interest rates stayed near zero. Asset prices surged. Governments borrowed more than ever. Central banks became permanent crisis managers. The invisible balance sheet grew to include pension obligations, aging populations, sovereign debt guarantees, shadow banking risk. None of this shows up cleanly on official ledgers, but markets price it instinctively. That's why central bank communication now moves markets more than fundamentals. Failed fixes. Why nothing really changes. Regulation increased. Stress tests multiplied. Capital requirements rose. But these fixes assume risks can be measured. The invisible balance sheet is about future promises and politically untouchable obligations. Digital currencies won't fix this. Neither will transparency alone. The problem is invisibility. Its structure. Modern parallels. The pattern repeats. Today, global debt is over 300% of world GDP. Central bank balance sheets are larger than ever. Crises happen faster. Interventions grow bigger. The pattern is clear. Flexibility, expansion, dependence of fragility. We're deep into dependence. Conclusion: what this means. 3 takeaways. First, Central banks manage expectations more than money. Second, every delayed loss becomes a future constraint. Third, the invisible balance sheet matters more than the visible one. A final thought, the danger isn't collapse tomorrow. It's a system that only works as long as everyone believes it will. And belief, unlike money, can vanish overnight. If you want more deep dives into the hidden mechanics of money, debt, and power, subscribe. Because the most important numbers shaping the future still aren't on the balance sheet.